In times of widespread enthusiasm and soaring stock prices, it's easy to get swept up in excitement. But if there's one voice in finance that cuts through the noise with calm clarity, it's Warren Buffett. While the world watches markets with wide eyes and open wallets, Buffett is quietly doing something most investors aren't, holding on to $341 billion in cash. Let that sink in. That amount exceeds the gross domestic product of many developed nations. And he's not doing it for show. Buffett's decision mirrors the exact playbook he followed before the dot-com crash of 2000, when his cautious strategy saved Berkshire Hathaway from devastation and allowed him to capitalize when others collapsed. But what exactly is Buffett seeing that the rest of the market is ignoring? And more importantly, what can you learn from his actions to protect your wealth in today's volatile environment? To understand Buffett's thinking, we must revisit two key indicators that he's used for decades to gauge the temperature of a market. These tools aren't obscure formulas. They're straightforward, intuitive, and proven. And right now, they're flashing bright red. The Buffett Indicator, a simple, devastating signal. The first is the Buffett Indicator, which compares the total market value of all publicly traded U.S. companies to the country's GDP. In 2001, Buffett called it probably the best single measure of where valuations stand at any given moment. Think of it as a thermometer for the market. When valuations rise far beyond the size of the real economy, trouble often follows. Historically, when this indicator crosses 100%, the market is considered overheated. Right now, it's sitting at 177%. That's not just high. That's historic. During the height of the dot-com mania, this ratio peaked around 140%. Today, we're well beyond that. It's like driving a car with the engine temperature in the red zone, ignoring the warning signs until smoke starts pouring out of the hood. Except in this case, it's your savings and investments that could catch fire. The Shiller PE ratio, a long-term reality check. The second red flag comes from the Shiller PE ratio, also known as the CAPE, cyclically adjusted price-to-earnings ratio. Unlike traditional PE ratios that can be skewed by short-term events, the Shiller PE averages earnings over the past 10 years. This smooths out the noise and gives a more accurate picture of valuation. Today, this ratio stands at around 33, more than double the historical average of 15 to 16. Every time we reach these kind of levels in the past, a significant correction has followed. High CAPE ratios don't guarantee an immediate crash, but they heavily suggest that future returns will be lower than average, and possibly negative when adjusted for inflation. This isn't speculation. It's statistical gravity. The historical echo, a lost decade revisited. What makes these warning signs even more chilling is how closely they resemble the environment leading up to the 2000 crash. Back then, markets were booming. Technology stocks soared. Everyone believed the internet would create unlimited value overnight, but the underlying numbers told a different story. From 2000 to 2012, the S&P 500 delivered an annualized return of just 2%, less than inflation. That means investors actually lost purchasing power by staying invested during that time. Bonds, dividend stocks, and even cash performed better. The lesson? High valuations don't just reduce returns. They erase them. And guess who warned investors back then? Buffett. Guess who ignored him? Almost everyone else. A mirror image of 1999. Look around today and you'll see the same behaviors. Sky-high valuations in tech. Frenzied excitement over AI and machine learning. Meme stock millionaires flaunting gains on social media. Retail investors chasing returns with borrowed money. These are classic bubble symptoms. And yet, Buffett isn't buying. In fact, he's doing the opposite. Instead of purchasing stocks, he's accumulating cash, just like he did in 1999. Back then, he refused to buy even shares of his own company, stating that prices simply didn't justify the risk. Fast forward to today, and he's following that same principle. No excitement, no speculation, just discipline. Buffett is like a master sailor watching a storm gather on the horizon, while everyone else races toward open water, drunk on sunshine. He's seen this weather pattern before, and he knows what comes next, where Buffett puts his money when he's worried. So where does a man like Buffett park $341 billion? He's not hiding it under a mattress. He's investing in short-term U.S. Treasury bills with yields between 4 and 5%. These government-backed instruments offer safety, liquidity, and modest returns, just enough to preserve purchasing power while he waits for better opportunities. You might wonder, why would the greatest investor of all time settle for such low returns when the stock market is surging? Because Buffett isn't focused on short-term gains. He's focused on long-term opportunity. He knows that periods of extreme overvaluation often end in correction or collapse. And when that happens, cash becomes king. It allows him to buy great businesses at bargain prices when everyone else is forced to sell. This isn't a theory. It's history. In 2008, Buffett used Berkshire's cash pile to scoop up preferred shares in Goldman Sachs and Bank of America, earning massive dividends and capital gains. Those moves generated billions in profit for his shareholders. His current war chest would allow him to do that again on an even bigger scale. Patience is not passive. To the casual observer, holding cash might look like inaction, but for Buffett, it's strategic positioning. It's like a chess grandmaster refusing to move a key piece until the board is favorable. That's what separates him from speculators. He doesn't act because the market moves. He acts when the odds move. Buffett once said, "You don't need to swing at every pitch. Wait for the one that's right in your sweet spot." Right now, the pitch is coming in high and fast, and he's letting it pass. Meanwhile, average investors are chasing AI stocks, crypto tokens, and meme trades. Why? Because they're afraid to miss out. But Buffett knows that missing out on bad trades is just as important as capturing good ones. Could you follow Buffett's strategy? Of course. Not everyone has billions to move around. But the principle behind Buffett's actions is scalable. You don't need to be a billionaire to act like one. Here's what you can do. Watch market indicators like the Buffett Indicator and Shiller PE. Increase your cash holdings as valuations become extreme. Choose safe, liquid places to store that cash, treasury bills, high-yield savings accounts, or money market funds. Stay patient. Wait for value, not hype. Build your career and income while the market cools. And most importantly, don't let emotion drive your investment decisions. This kind of thinking isn't just smart, it's resilient. And resilience is what builds lasting wealth. As we move into part 2, we'll explore how Buffett's dry powder strategy has created windfalls in the past, and how you can apply the same principles on your own scale, especially during turbulent markets. But before you go, take a moment to reflect. Are you building your portfolio for hype or for opportunity? If you found value in this insight, share your thoughts in the comments. Which indicator do you personally watch, if any? And if someone you care about is investing without a strategy, forward this to them. It can make all the difference. When markets are rising and headlines praise daily gains, patience begins to feel like weakness. But for Warren Buffett, patience isn't just a virtue, it's a strategy. And history shows it's one of the most profitable traits an investor can cultivate. Let's look at how Buffett's cash-heavy strategy has played out during past crises. Because this isn't the first time he stepped away from the action while others rushed in blindly. The dot-com bubble, when Buffett said no in the late 1990s, the stock market was euphoric. The internet was booming. Startups with no profits, sometimes not even products, were being valued in the billions. Everyone wanted in. Everyone believed they were early to a new era. Everyone except Buffett. While others scrambled to invest, Buffett held back. He refused to buy into hype. In his 1999 letter to shareholders, he warned investors that market expectations were wildly disconnected from reality. He openly questioned how long such optimism could last. And he was right. From March 2000 to October 2002, the Nasdaq dropped nearly 80%. The S&P 500 lost almost 50%. Fortunes vanished. Portfolios were decimated. But Buffett, he emerged from the wreckage not only intact, but stronger, because he had cash. When stocks were being dumped at fire sale prices, he had the power to buy. That's not market timing. That's market preparation. The 2008 financial crisis, a playbook of precision. Fast forward to the 2008 financial crisis. Housing prices had reached absurd levels. Mortgage lending had spiraled out of control. Financial institutions had over-leveraged themselves in toxic debt. Buffett once again stood back, stockpiling cash. When the crash came, he moved decisively. He invested $5 billion in Goldman Sachs, securing preferred shares with a 10% dividend yield plus stock warrants. He put another $5 billion into Bank of America with similar terms. These weren't just emergency investments. They were profitable bets on American recovery. By 2013, the Goldman position alone had earned Berkshire an estimated $3.7 billion in profit. The Bank of America stake eventually produced over $12 billion by 2017. This isn't luck. This is what it means to be prepared when others are panicked. Buffett understands that the real money in investing is made not when you buy or sell, but when you wait. Wait for prices to disconnect from value. Wait for the crowd to lose its nerve. Wait for the moment when you can act from strength. The mathematical power of cash. Why is cash so powerful during downturns? Because when a stock drops 50%, it doesn't need to rise 50% to break even. It needs to double. That's a 100% return just to get back to where you started. Now imagine holding cash during that drop. When prices fall 50%, you can buy twice as many shares. If the stock returns to its original price, your investment doubles. That's the asymmetry Buffett is playing for. He doesn't try to guess the top or bottom. He doesn't make predictions. He just waits until the odds are tilted massively in his favor, and then he moves. Cash is optionality. In Buffett's view, cash isn't idle, it's optionality. It's the ability to act with power and speed when opportunities appear. He doesn't need to know when the market will fall. He just knows that eventually it will, and when it does, he'll be ready. He once said, "Opportunities come infrequently. When it rains gold, put out the bucket, not the thimble." You can't do that if your portfolio is stretched thin, chasing every trend. Cash provides three distinct advantages. Protection. It shields you from drawdowns when the market corrects. Psychological comfort. It gives you the confidence to stay disciplined and unemotional. Buying power. It positions you to buy high-quality assets at low prices. But let's be honest, most investors don't have Buffett's patience. They're afraid of missing out. They fear falling behind. They feel pressure to always do something. That's where mistakes are made. Real people, real mistakes. Let me tell you about Tom, a client I once worked with. In 2007, Tom's portfolio was booming. His co-workers were bragging about tech stocks. Even his dentist was giving him investment tips. Tom didn't want to be the only one missing out. Despite early warning signs and rising valuations, he kept his money fully invested. Then came 2008. By the end of the crash, Tom had lost 45% of his retirement savings. Worse, he panicked and sold at the bottom, locking in his losses. It took him nearly a decade to recover. Now let me tell you about Sarah. In 2019, Sarah maintained a 25% cash position, despite friends calling her too conservative. When COVID-19 hit in March 2020 and markets crashed, she calmly deployed half of her reserves into top-tier companies trading at deep discounts. By mid-2021, her investments had doubled in value, while others were still licking their wounds. The difference? Sarah had a plan. Tom had fear. How much cash should you hold? Obviously, not everyone can hold 33% of their net worth in cash like Buffett. Your cash position should be based on your life stage, goals, and risk tolerance. But some general guidelines apply. Younger investors under 40 maintain 10 to 15% in cash when valuations are extreme. Nearing retirement, 50 plus consider 20 to 30% or more, depending on market conditions. During a bubble, like today, gradually increase your cash as indicators worsen. And don't make this change all at once. Build your reserves slowly over time to avoid drastic missteps. Where to park your cash. Buffett uses short-term U.S. Treasury bills, which are government-backed, ultra-safe, and currently yield between 4 to 5%. Individual investors can access the same instruments through treasurydirect.gov, minimum investment $100, high-yield savings accounts, often FDIC insured, money market funds, offering competitive yields and daily liquidity. These options keep your money safe, while generating small but stable returns and preserving your purchasing power, a key concern in high inflation environments. Cash is not laziness, it's leadership. It takes strength to hold cash when others are celebrating gains. It feels wrong. But remember, when everyone is excited, risk is hiding. Buffett doesn't sit on $341 billion because he's afraid. He does it because he sees something others don't. And he's done this before. The results speak for themselves. So ask yourself, are you rushing to catch the next wave or patiently preparing for the next opportunity? As we continue to part 3, we'll explore how Buffett's principles can be adapted to your personal investment strategy, no matter your income level, and why waiting may be your strongest move in today's climate. But before you go, if this message brought you clarity, share your thoughts below. What's your cash strategy? How do you balance patience and action? Add your voice. We read every comment. Warren Buffett's $341 billion in cash isn't a sign of indecision. It's a declaration. It says that being ready matters more than being early. It reflects a deep understanding that markets are ruled not by logic alone, but by cycles of greed and fear. And the biggest fortunes often go to those who are wise enough to wait for fear to return. So how do you apply Buffett's philosophy to your own life when you're not managing a multinational empire or overseeing billions of dollars? It starts by recognizing that successful investing is not about catching every upswing. It's about staying alive through the downswings. It's about surviving with enough capital and composure to take advantage of true opportunity. Practical lessons from Buffett's playbook. Let's break down the core principles that make Buffett's strategy adaptable to everyday investors. 1. Build cash gradually in overvalued markets. You don't need to sell everything at once. Start by trimming riskier positions, pausing new buys in inflated sectors, and redirecting dividends or bonuses into cash reserves. The goal isn't to abandon investing, it's to reallocate wisely. 2. Use simple, safe vehicles. Buffett doesn't complicate where he stores cash. He sticks with short-term U.S. Treasury bills. You can do the same, or use FDIC-insured high-yield savings accounts and money market funds. These provide liquidity, safety, and some yield, critical when inflation is eating at stagnant savings. 3. Respect your risk tolerance. Your cash allocation should reflect your personal risk level. If market drops cause you anxiety, more cash can help you sleep at night and keep you from panic selling. On the other hand, if you're young with decades ahead, keeping some cash for opportunity while maintaining regular market exposure can offer the best of both worlds. 4. Invest in yourself while you wait. Buffett once said, "The best investment you can make is in yourself." Use this quieter time to upskill, grow your income, or build a side business. A 10% raise at work, compounded over years, may dwarf the gains of a lucky stock pick. The smartest investors don't just manage money. They grow their ability to earn and reinvest. 5. Define your strike zone. You don't need to swing at every pitch. Identify the types of investments you understand best, your circle of competence, and wait for them to go on sale. When great businesses fall out of favor temporarily, that's your window. Investing is a mind game. Most of the traps investors fall into are emotional, not technical. Fear of missing out, fear of looking foolish, fear of falling behind. But Warren Buffett doesn't operate from fear. He operates from clarity. When markets are hot, Buffett becomes cautious. When markets are cold, he becomes courageous. It's counterintuitive, but it's exactly why he's outperformed generation after generation. This mindset is best summarized by Charlie Munger's timeless insight. The big money is not in the buying or the selling. It's in the waiting. Waiting is hard, especially when everyone around you is bragging about gains. But the investors who build lasting wealth are those who understand that risk is often invisible, and that patience is a tool that reveals it. Think in decades, not days. The market is a machine designed to transfer wealth from the impatient to the patient. That's not a slogan. It's a statistical truth. Investors who check their portfolio daily are more likely to react emotionally. They chase trends, follow hype, and act on noise. But those who think in decades, who invest in quality, who hold cash for downturns, who treat investing as a discipline, not a game. These are the ones who end up ahead. Imagine this. The next major downturn hits. Valuations fall. Panic spreads. Headlines scream about collapse. But instead of fear, you feel readiness. You've been building cash. You've made your list of quality companies. You have a plan. That's the difference Buffett is modeling for us right now. His $341 billion is not idle money. It's a silent roar, a patient signal to the world that the time for action will come. And when it does, he'll be the one buying, not scrambling. You can do the same, even without his fortune. Final thoughts. Buffett doesn't chase hot tips. He doesn't listen to noise. He doesn't rush decisions. He watches, waits, prepares, and when the moment comes, he acts with precision. If you can adopt even part of that mindset, your investing journey will feel calmer, smarter, and more rewarding. You don't need to be Warren Buffett, but you can learn to think like him. As this conversation closes, reflect on how you're positioning yourself, not just financially, but emotionally. Are you building the mental framework to invest like a master? And remember, it's not about predicting the next move. It's about being ready for it. If this message gave you new clarity, let it spark conversation. Tag someone who might benefit. Or better yet, share in the comments how you plan to apply Buffett's mindset to your own strategy. You never know who needs to read your story today.